buy, borrow, die gets sold like a magic trick for people with 50 million in assets. For them, it is magic. Private banks roll out the red carpet. For us, it works differently. But here's what nobody tells you. The mechanics still help at normal income levels, just with different tools. Quick reality check. When Elon Musk borrows against his Tesla shares, he gets maybe 2 to 3% interest rates. The bank practically begs him to take the money. You know what rate they offered my neighbor Steve when he tried to borrow against his $50,000 E-Trade account? 11%. And they wanted him to keep 200% collateral, meaning he could only borrow 25 grand against his 50. That's not exactly the same game, is it? But here's where it gets interesting. Steve's brother-in-law, Mike, drives a truck for Cisco, makes about $70,000 a year. He figured out something else. Instead of trying to copy what billionaires do with stocks, he asked a simpler question. What do banks actually want to lend against at decent rates? Answer: property, small cash-flowing businesses, and certain types of life insurance that nobody on YouTube talks about because, frankly, it's boring and you can't sell a course on it. The mistake everyone makes is trying to photocopy the billionaire playbook when what we really need is a translation. It's like watching Gordon Ramsay make beef Wellington and thinking you need to do exactly that, when what you really need is just how to cook a decent meal with what's in your fridge. So forget the fantasy of never paying taxes. That's yacht talk. What we're talking about is how regular people can build real wealth using the boring, unsexy versions of these same principles. And the first step isn't buying stocks at all. Your first buy that matters. Let me tell you about Maria. She's a dental hygienist in Ohio, makes about $55,000 a year. 3 years ago, she had 15 grand saved up and everyone, literally everyone, told her to dump it in the S&P 500. Just let it compound, they said. She bought a garage instead, not a fancy garage, a double garage with a tiny apartment above it, sitting on a corner lot in a so-so neighborhood. Cost her $72,000 total. She put down the $15K, got an FHA loan for the rest at 3.8% interest. Here's the thing nobody explains. When you buy stocks with 15 grand, you own 15 grand worth of stocks. Period. When you buy property with 15 grand down, you control 72,000 worth of asset. The bank just became your partner, except they don't want any of the profits. They just want their monthly payment. Maria rents the garage bays to a guy who fixes motorcycles, $600 a month. The apartment above, another $750 to a retired teacher. Her mortgage payment, $410. After taxes and maintenance, she clears about $500 monthly. But that's not the interesting part. 8 months later, the property appraised at $85,000. The bank called her up, asked if she wanted a home equity line of credit, a HELOC. Now, a HELOC is basically a credit card backed by your house equity. You only pay for what you use, and the rates are way better than credit cards. They offered her 20 grand at 4.5%. If she'd put that original $15,000 in stocks and they'd gone up the same percentage, she'd have made about $2,700. Nice, but she can't borrow against it without selling. With the property, she can pull out $20,000, keep the rental income, keep the asset, and the tenants are literally paying off both loans for her. Maria wasn't a real estate genius. She YouTubed how to screen tenants. She called 3 contractors for quotes when the roof leaked. She figured it out as she went because, and this is crucial, you don't need to be smart about this. You need to be not stupid. There's a difference. The smart borrowing ladder. So now you've got an asset. What most people don't realize is borrowing has layers, like a ladder where each rung gets you somewhere different. Maria's HELOC, she didn't use it to buy a boat. She used 12,000 of it to buy a vending machine route. I know, weird choice, right? But follow this for a second. 6 machines already placed in offices and break rooms. The previous owner was retiring and wanted out quickly. The machines were generating about $1,100 a month in profit after restocking. Here's where people mess this up. They think borrowing means gambling, like you're supposed to take the money and, I don't know, flip houses or day trade options. Number. You borrow to buy boring things that print money, vending machines, laundromats, a pressure washing trailer. Things so boring that nobody makes TikToks about them. 6 months in, Maria's got documented income from the vending business. She walks into a credit union and applies for a business line of credit. Not a loan, a line of credit. The difference is you only pay interest on what you use. They approve her for $30,000 at 7%. Not secured by anything, just based on her business cash flow. Are you following this? She went from one rental property to having $50,000 in borrowing power, and the borrowed money is paying for itself through the businesses it bought. This is the latter. Property equity, HELOC, cash flowing micro business, business cash flow, business credit. Next logical step, SBA-backed loans when the numbers justify it. But here's what'll kill you. People get excited and skip rungs. They'll take a HELOC and dump it into some guru's course, or cryptocurrency, or their brother's sure thing restaurant idea. That's not borrowing. That's gambling with your house as collateral. Hard rule, never borrow to buy something that doesn't generate income immediately. Not will generate or should generate, is generating. Today, right now. The die part nobody talks about. Okay, this is going to sound morbid, but we need to talk about what happens to all this when you're gone. The billionaire version is simple. They die. Their heirs inherit everything at a stepped-up basis, meaning the tax meter resets to zero. Beautiful for them. Irrelevant for us. My friend's Uncle Tony, postal worker for 30 years, he figured out the regular person's version by accident. Bought a whole life insurance policy in his 30s. Everyone said he was stupid. Term is cheaper, they said. Invest the difference, they said. But after about 12 years, his policy had $40,000 in cash value. The insurance company let him borrow against it at 5%. No credit check, no application, just a phone call. He used that loan to fix up his mom's old house after she passed, turned it into a rental. Here's the weird part. He never paid back the loan. Just let it ride. When he died last year, the policy paid out $250,000 to his kids, minus the $40,000 loan. They got $210,000 tax-free, plus the rental property with a stepped-up basis, plus his little landscaping business. Total inheritance, about $400,000. Taxes owed, zero. Tony never made more than $65,000 a year in his life. This isn't about avoiding taxes like you're some criminal mastermind. It's about using the rules that already exist, rules that nobody explains because they're boring. Set it up while you're boring and healthy. Get adequate term life for protection. Consider a modest cash value policy for borrowing optionality. Hold rentals in an LLC with clear beneficiary instructions. Simple will, updated beneficiaries, one-page asset list with instructions. Keep records clean so heirs can step in without chaos. 3 real paths, 3 real people. James. A high school teacher from Texas bought a $95,000 condo near community college. Lived in one room, rented 2 to students, $1,200 coming in, 600 mortgages. Today, 4 units, $400K in property, $2,800 monthly after expenses. Uses a portfolio loan, all properties underwritten together for better rates. I still teach. My daughter's learning to manage them. Anna, a dental assistant and a single mom, started with $10,000 life insurance cash value her grandmother left. Bought a small cleaning business, 3 contracts, van, equipment, from someone desperate, divorce situation. Kept her day job, cleaned offices at night. Year 4, sold for $140,000, bought a 4-plex. Done. Just collects rent and raises her kids. Marcus, a plumber with $90,000 income, always broke. New truck every 3 years. Toys in the garage. A heart scare at 44 changed everything. Used his paid-off work van as collateral for $20,000. Bought carpet cleaning equipment. Same plumbing customers needed water damage cleanup. Extra $3,000 monthly. Used that income to qualify for $25,000 business credit. Bought the workshop he was renting. His old rent now pays his mortgage. 3 different people. 3 different starting points. No moonshots, no copying billionaires. Just the next logical step, then another, then another. The boring stuff that actually protects you. Before I show you how to execute this, we need 2 minutes of protection, because this is where people lose everything they built. Your cousin who says, just put it all in your wife's name? That's not protection, that's playing pretend. What actually works? LLCs. $150 in a one-page form. Your rental becomes its own entity. Someone slips on your stairs? They sue the LLC, not you personally. But an LLC without insurance is like a bulletproof vest made of paper. $1 million umbrella policy? $20 a month. People spend more on coffee. Separate everything. True story. Guy I know had 3 rentals in an LLC. Doing great. Paid for his kid's birthday party from the business checking. Just once. When a tenant sued over a ceiling collapse, their lawyer found that one transaction. Judge ruled the LLC was a sham. Lost everything. It's called commingling, and it's the fastest way to lose everything. Death paperwork. A will costs $500. Dying without one? Your family spends $10,000 minimum in probate, waiting a year to access anything. Your rental income stops. Everything freezes while lawyers get rich. This stuff isn't sexy, but it stops you from becoming poor after you've done everything right. The bottom line, look, you're not going to borrow millions against your stock portfolio. That's not your game. Your game is simpler. Buy boring assets that banks understand. Borrow against them to buy more boring assets that generate income. Structure it so your kids get it all without the government taking half. Start where you are. A garage apartment, a vending route, a pressure washing setup. Whatever you can actually do this Monday morning. The billionaire version of buy, borrow, die is a fantasy for normal people. But the principles, acquiring assets, leveraging them smartly, passing wealth efficiently, those work at any level. You just need to stop trying to be Elon Musk and start being the boring millionaire next door that nobody makes documentaries about. If this opens your eyes to what's actually possible, hit subscribe and drop your biggest question below. I read everything and it helps me know what to cover next. That's it. That's the whole thing. Not complicated, not sexy, but it actually works.